But by and large, if you are using 10K based fundamentals for your research, for your equity research, you are missing intangible assets because the investment in those types of assets are expensed. And so they are actually coming out of free cash flow, and then they're not getting accumulated into a stock of something that is going to be used to create future free cash flows. So these spending money on software, consulting to improve teamwork, paying your research and development team to come up with new ideas, new products, new processes. We all know those are investments in the sense that we are building something that's going to increase our cash flow down the road. But to build those stocks, you have to dig into the actual expenditures to create that intangible asset stock.
Welcome to AFO Wealth Management Forward, a podcast powered by Arrowroot Family Office that's at the intersection of accounting, wealth management, behavioral finance, technology, and entrepreneurship. We help accounting firms and financial advisors grow their practice by going beyond the numbers as we learn from industry leaders and subject matter experts to discover the secret to their success. A podcast that highlights everything from the transformative power of AI to embracing the human-first approach of behavioral finance to help you understand the psychological and emotional relationships to money and meaning. Here is your host, Rory Henry, director at Arrowroot Family Office and author of Holistic Guide to Wealth Management.
All right. Hello, everyone. I have another phenomenal guest joining me today. She holds a PhD in economics from the University of Chicago and is currently a professor of finance at UCLA Anderson School of Management. Her research over the years has focused on macroeconomics and finance, as well as the role of intangible assets in asset pricing. She also holds editorial roles at the Journal of Monetary Economics and the American Economic Journal. She recently launched her Next Intangible Value Index ETF, as well as the Simplify Next Intangible Core Index ETF. I'm excited to have her join me today. So without further ado, let me introduce our guest, Andrea Eisfeldt. Andrea, welcome to the show.
Thanks so much, Rory. It's great to be here.
I mean, that was my cut down version of your credentials. I could have gone on and on and on. So for those in our audience that don't know you, Andrea, can you give them a background of what you do here?
Sure. So yeah, I'm a research economist. I got my PhD at the University of Chicago. I've been an academic and a professor for 25 years, but took a couple of years leave of absence. I was chief economist at a hedge fund. I consulted with AQR for several years after that. I sit on the board of the UCLA investment company. So I've gotten some asset management experience. And like you said, I've done, research on an array of topics in macroeconomics and finance, including market liquidity and credit and mortgage topics. But a large body of my research is really focused on the measurement of this really important class of assets, intangible assets. We all know they're important and we all know they're hard to measure. So I kind of decided to spend many years thinking about that.
Oh my gosh. Yes, they are hard to measure. And I was reading one of your research papers that was done, I think back in 2021, and they talked about the S&P 500 back in 1975. Intangible assets made up just 17% compared to 83% tangible assets. And then it flipped as of 2018. It was 84% intangible and 16% tangible. I'm sure that's only increasing. Can you talk about the evolution of the shift towards intangible assets?
Sure. Yeah. So like you mentioned, if you think about the economy, when we first started really doing systematic equity research and quant kind of research in the 90s, we were looking back into an economy that was the 80s and 70s, and that was a very different economy. The mix of industries was different. So we had much more manufacturing back then. And even within industries, the mix of assets was very different. We had a lot of property, plant, equipment. We had heavy machinery being an important class of assets back then. And then you fast forward to today, And we have firms that you would say, well, they're asset light, but they're not really asset light. They've got all these intangible assets.
Yeah.
We have a much more important tech and communication sector, but even within retail and manufacturing, we have a ton of R&D and brand
Yeah.
capital and organization capital. So just like you said, we've totally shifted from an economy that was primarily comprised by tangible assets that we use to
Yeah.
produce all the things we know and love, to one where intangible assets are the ones that are giving us, utility and products that we enjoy and use every day.
Well, let's kind of take a step back here for our audience members that don't know what intangible assets are. I like your breakdown of the three different segments. You broke it down in knowledge, brand, and organization. Can you kind of give a definition for our audience about the various intangible assets?
Sure. So yeah, we as economists like to, put as much structure as we can, even on things that are hard to think about.
Right.
So knowledge assets would be things like that are produced by R&D, like patents,
Code.
processes,
Yeah.
new drug formulations, that kind of thing. Brand capital, we would think about as your relationships with your customers. It could be a network of customers. So like Uber has a network of customers. It can be your sales and marketing list, your customer list, all that kind of customer data. And then we have organization capital, which is actually the biggest category of intangibles. And that is one of the trickiest ones to measure. And that's actually where I started my research, was on the relationship between organization capital and equity returns. But those are things like the organization structure, is it more pyramid or horizontal?
Yeah.
Like, it's the corporate culture. How well does your team work together? It can be your key talent. And that's what's I think really interesting about organization capital, is kind of jointly
Yeah.
owned by the firm, and so owned by the equity holders and the debt holders,
Yeah.
but also owned by us as employees of firms.
Yeah. Well, let's talk about then the accounting aspect and how we are valuing these things, because with those accounting standards, gap, right? Those were for a more tangible economy than manufacturing economy. So can you talk about maybe the issues around how we're valuing these intangible assets and the accounting aspect of this?
Yeah, so the accounting issues are super interesting. I think you have an accounting background.
Yeah.
Accounting
Yeah.
are very conservative, right?
Yes. Yes.
So it's sort of like there is always this trade-off between precision and accuracy.
Yeah.
But with the economy being mostly intangible assets, we do have to tackle this issue, and it's been very slow moving. So if you look at accounting statements, back to even the early 1900s, you have the same categories. The
Mhm.
income statement looks kind of similar, the balance sheet looks kind of similar, yet firms have totally different activities and totally different assets. Now, it's not the same everywhere in the world. You have some like R&D types of assets capitalized in places like France.
Mhm.
And it's not the same in corporate accounting as it is in national accounting. So
Yeah.
like the Bureau of Economic Analysis did a major revision in 2013 and started including some patents and artistic licenses and things like that in the capital accounts. But by and large, if you are using 10K based
Yeah.
fundamentals for your research, for your equity research, you are missing intangible assets because the investment in those types of assets are expensed. And so they are actually coming out of free cash flow, and then they're not getting accumulated into a stock of something that is going to be used to create future free cash flow. So these spending money on software, consulting to
Yeah.
improve teamwork, paying your research and development team to come up with new ideas, new products, new processes. We all know those are investments in the sense that we are building something that's going to increase our cash flow down the road. But to build those stocks, you have to dig into the actual expenditures to create that intangible asset stock.
Yeah. Is this what the existing ETFs and equity products you think are missing as far as incorporating intangible assets?
For sure, for sure. So I believe that the to simplify Next, ETFs are the first to systematically measure at the firm level the stock of intangible assets, and then to use that to form a portfolio for, and it does it in two ways. So the next intangible core portfolio is it's an index, and the product is based on an index that weights more heavily towards firms that have a higher ratio of intangible assets to tangible book assets.
Yeah.
And then the next next intangible value index and ETF is a value product that thinks about fundamental value, how you can measure that when you have, the majority of a firm's assets being these intangible assets. And it totally changes the way you think about firm fundamental value.
Yeah. Is there, for example, that you can provide here talking about how this concept of was it intangible adjusted book value, you can capitalize the SG&A expenses? Is that what you're doing there?
Yeah. So let's talk about how we do that.
Yeah.
So like I said, if you think about your R&D processes, your advertising expenditures, your expenditures on team building, management experience, key employees that you want to retain, all of those things are expensed.
Yeah.
So we are using the expenses, including the SG&A expense, the R&D expense, the advertising expense. We have ways of using what economists call a perpetual inventory method, which is kind of the same way you would treat your CapEx as a flow that then you would build up to your stock. So your accounting statements would kind of flow from one year to the next when you include depreciation and kind of where you started the year to get to where you ended the year. We are doing that with the expenditures on intangible assets. And there are a lot of important details. Like I said, I've been working on this since at least 2008, 2009.
Yeah.
So there are a lot of important details in particular because there's so many differences across industries in terms of reporting.
Yeah.
So you mentioned GAAP doesn't require you to really break out your expenditures on R&D or advertising. And it's up to the firm what they're going to classify as selling general administrative expense versus cost of goods sold. Every firm, every industry will have some processes in place to make those decisions. So the key is to be looking at what the industry standards are, what the firm's practices are, to know how to treat those expenditures at the firm level to accumulate them into a stock. So we do everything within industry to account for the differences in reporting practices across industries. Some industries really report advertising because it's a competitive advantage to report it. Others don't report it separately because they don't necessarily want to reveal what their advertising strategy is. And it's the same with R&D and some of the other categories. But ultimately, we come up with an intangible stock that is measured at the firm level that takes into consideration reporting standards for that firm's history and for the industry standards to come up with that intangible stock at the firm level, and how that changes and accumulates over time.
Yeah. And so you're taking the 200 select stocks from the US 3000. I think you tracked the sole active US 3000 index, right? And you're taking the 200 stocks with the highest intangible capital to book asset ratio.
Yeah, so bearing in mind there are two products and they're different. So they're both focused on incorporating intangibles.
Right.
They both start from what is pretty much like a total market universe, when you take the top 3,000 firms. So we do use the selective 3,000 index at US index as our starting point. It's going to be very similar to any, total market universe. And for the core index, that is designed to track the total market. So the benchmark is, the total market index, but we're going to generate some anticipated additional returns by picking the firms who have more intangible assets relative to tangible assets out of those 3,000 stocks, with the idea that when you have more intangible assets than your industry peers, you are positioned at the frontier of your industry. So
Yeah.
you have the best R&D, you have the best brand, and you have the best team. And that creates a competitive advantage for you that should show up in your future returns. So that's the thesis behind Intangible Core. Let's pick the firms within their respective industries that way more towards intangible to tangible assets, with the idea that intangible assets are not, they're the present and they're the future. So
Right.
picking these firms will kind of weight you towards what's going to do well in a forward-looking manner. Of course, no, it can't guarantee future returns, but this is the thesis behind the research. The next intangible value index is really a value product. So,
Mm.
if you think about the most basic principle of investing, it is buy cheap and sell
So
expensive.
expensive.
You can't get away from that, right?
Right.
So that's you always want to buy cheap, sell expensive, but then the question is, well, how do you know what is cheap? How do you know what is expensive?
Yeah.
And that is the holy grail. What is the
Right.
fundamental value that you want to compare the market price to? And historically, people have used things like book value was the
Mhm.
classic that is completely outdated, as we talked about, because
Yeah.
book value has none of the intangibles in
Tangible.
it.
Mhm.
It's going to be, when you choose based on book value, you might choose some value traps. You might get some real industry tilts in there. But even other fundamental measures like sales or earnings and things like that, those also are not necessarily forward looking.
Right. Yeah.
And
Future. Yeah.
so, and we really want to think about what's the market value of this firm, that's the price you're going to pay, relative to what you are actually buying. And we think including the intangible assets with the firm's book assets is going to give you the best measure of that fundamental value. And that proof is in the pudding in terms of the back test. When you look
Yeah.
at the intangible value index relative to any other value product, the outperformance in the back test, is I think pretty striking. And that's, we know that, there are tech firms that are value firms. You just got to include those intangible assets, or the whole sector is going to look like growth. The next value product, the basic idea being that you want to adjust the fundamental value of what you're deciding between when you're thinking about what is cheap versus what is expensive.
Ah.
And as we talked about earlier, firms' book values is just not
Right.
representative of what their fundamental value is, just because of the asset composition being heavily weighted towards things that don't show up in book value. So if you include the intangible assets along with book value, when you're thinking about what are you paying for when you pay that market price, you're paying for the fundamental assets of that firm that include all the physical assets, but also the brand, the R&D, the team. And then once you include those intangible assets, you can start to think within an industry, what looks cheap, what looks expensive. And doing that keeps you from investing in value traps, which are firms that, they have a cheap price for a reason. They haven't invested not only, they have a low market value, but they haven't invested in the intangibles that are going to help them have higher cash flows going forward. And it also avoids shorting or not buying firms that look like growth if you only look at big book assets. But if you include the intangibles, you get tech firms that are actually a good value,
Yeah.
because the market value is high looking at just market to book. But if you look at market to book plus
Plus
intangibles,
intangibles.
you find value even in sectors like tech and healthcare.
Yeah, because some are seeing that the tech stocks are overpriced. We're sitting on the top three stocks being at 3.2 trillion dollars. So, obviously the tech sector is heavily involved in investing in intangible assets. So the other sectors, though, there's opportunities there for those firms as well. So are you concentrated on the other sectors besides tech
Yeah, so couple of things. First of all, both of these indices are industry neutral.
Yeah.
And that is actually good. That's best practices generally when you're looking at quant factors. You don't necessarily want to get an industry tilt. You want to stay industry neutral, but then pick the best firms within each industry. And that is what these indices are doing. So
Okay.
the second thing I would say is right now, as you mentioned, we've got some big stocks that
Yeah.
are a large part of everybody's portfolios. They have high valuations, pretty much whatever statistic you look at normalizing
Right.
them by. And what I'm going to tell you is you can get diversification using these two indices because neither one of them is market cap weighted without considering the either intangible to tangible assets or the intangible value factor. So when you look at the composition of these indices, you're going to get something different from what you get when you look at just a value weighted index. And I think there's no more important time than right now to
Yeah.
get something that's not just market cap weighted, because market cap weighting is really giving you a lot of exposure to a very small number of firms.
Yeah.
Like you said, it's one, and also one industry.
Yeah, right. No, I agree. I agree. Now, we talked before the recording here about creating these indices and ETFs. Can you talk about what led you to this role? And then do you see other people following suit here and jumping on board the intangible asset bandwagon?
Are you an accountant looking to generate more revenue and secure your future success as automation and artificial intelligence revolutionize the accounting profession? If so, contact us at AFO Wealth Management Forward. We specialize in helping accountants and advisors just like you build a custom brand to pinpoint your optimal clientele, generate highly qualified leads through our data-driven digital marketing, and execute wealth management growth services to bring more value to your firm and your client's life. Our strategic approach to branding, marketing, and wealth management is carefully tailored to attract ideal clients, increase customer retention rates, and cultivate lasting relationships with clients across generations. Visit wealthmanagementforward.com to book your free consultation to find out how you can elevate your practice.
Sure, yeah. So, yeah, I mean, I was always interested in what made some firms more productive, more nimble, more able
Yeah.
to stay on the frontier than others. I had worked on, business cycles and how firms finance themselves, and I got really interested in, what is that intangible
Mhm.
asset that allows some firms to really be better than others and to really create value for us and be stronger within their industry. And so I did some research with accounting. I started out as a college accounting major, and I always say that's like one of the best things I did, even though I switched into econ,
Oh,
and
hold
became
on. There's a
an
pipeline
economist.
problem. There's a pipeline problem in the accounting profession, Andrea. I want you to restate that again for the audience because we're not getting enough accounting students that are taking the classes and graduating or becoming CPAs. So if you could restate
Well,
that. Great.
I had no idea. So I entered University of Illinois as an accounting major, and I took all the core accounting classes, and then I got into economics and I got into these big questions
Yeah.
about growth and firm values and things and I ended up getting my PhD in economics. But in terms of research and teaching, those foundational accounting classes were crucial. And I think, if you want to do equity investing, knowing what you're looking at when you use fundamental data,
Yeah.
you are using accounting data. So you really want to understand how those accountants made the decisions they did when they put the numbers together.
Yeah.
So I can't emphasize enough. So for anyone who's thinking about, what they want to study if they're interested in finance, and I've been telling my own family this, I've got boys,
Yeah.
that accounting, I think you want to start a business, you want to equity invest. It's really a great foundation for
Good
everything.
foundation. Yeah.
And that did inspire me because it is one of the challenges for accountants how to measure intangible assets. But I started to work on measuring intangible assets. Like I said, it was before the first paper that I published that won the best paper prize in the Journal of Finance on organization capital and equity returns was published in 2013. And I know I started working on it, a few years before that. And it was really trying to understand how intangible heavy firms were performing relative to their more tangible tilted counterparts, with this idea that more intangible assets give you that competitive edge. When I was consulting in asset management, those were during some of the most dire years for traditional value. And I'm a Chicago student. I'm well trained in all the factors. But I just thought, it just was really hitting me in the face. Looking at value without intangible assets, you cannot get at fundamental value. You cannot understand whether something's cheap or expensive without measuring the intangibles, because it's the majority of the firm's assets.
I mean, what we
So
say, 86% as of 2018. Obviously, it's higher now. If that's the makeup of these companies, how are you not diving deeper into this?
You got to do it. You got to do it, and you have to get your hands dirty. You have to look at the details. You have to know your accounting, and it is one of those things. It's not a number you pull out of the 10K, but the data is there to build these intangible capital stocks. And the great thing was, when I thought we need to include intangibles and looking at fundamental value to measure value, the amazing thing was how much the performance improved, because value, like I said, it's the bread and butter of finance. Buy cheap, sell expensive. Don't buy if you buy market weighted index, you're going to get the most expensive stocks. So it was great to see that thesis play out, that when you include the intangible assets, you drastically improve the performance of the value strategy.
Yeah. So is that why people should partner with Simplify ETFs?
Well, that and many reasons. So I'm really happy I found Simplify, because you really need a firm that is not invested in the old ways, because you can't say, well, oh, we've got, these really large value products, but actually those aren't what you should be in anymore. So Simplify is a very modern, very I would say frontier, high intangible assets, great human capital, such great team firm. And as soon as I connected with them, they just understood, the light bulbs it was just, as obvious to them as it was to me. So that is why I partnered with Simplify. Was we met at a conference, and they have some great UCLA alums, as well as some great Midwestern connections. Go Bruins. So that's why we partnered, and yes, that and many reasons for having those next indices in your portfolio, both to capture that value thesis in a modern way, and also to get that factor diversification from going away from the largest however many names we're talking about now. It keeps getting to be a smaller number. It was 7, 5, soon we'll have a 3 or something like that. So we have a lot to offer, I think, with the next suite.
I like it. So once put on your future goggles here, what do you see as far as the future of portfolio formation?
Yeah, I think that's a great idea. And I think about that a lot. I teach fintech, so we teach a lot of the innovations in wealth management, and we've seen some trends with robo-advising. We've certainly seen a big adoption of exchange traded funds and ETFs playing an important role in people's portfolio. We've also seen a lot of growth in passive, and a growth, also money allocated to those smart beta or style factors that can give you that potential edge over just a value-weighted index. And we've seen a growth in things that I think of as, meme trends. So you can call it a one stock thing. You get sectors that have meme, you have products that are meme oriented. So I think that future of investing is a really interesting question. I do believe in diversification, but I also do believe in tilts away from a market cap weighted index,
Hmm.
either towards value. So don't, these are old ideas. If you buy the market cap weighted index, you're more heavily weighting the most expensive firms. So I believe in the value thesis. But also I believe in looking at those firms that have invested in the assets that are going to give them the competitive edge within their industry going forward. So the future of portfolio formation, I think, includes it includes a role for passive. It includes a role for indexing. It includes a role for factor tilts.
Mhm.
And I'm not going to tell people what they should do with their money
Yeah.
in terms of the kind of memes and things that people like to enjoy and have fun with, because it's their money after all.
Yeah.
But I think, if we stick with the classic rules of, buy cheap, sell expensive, and diversification helps you to balance out the bumps and wiggles in
Yeah.
individual firms, then I think we get to something pretty sensible.
I like it. I like it. All right. So I would be remiss if I didn't I didn't ask you about Gen AI, because I saw one of your recent presentations talking about Gen AI and the exposure to different occupations. Can you talk about what you're seeing in that space and what potential impact it can be to different industries and occupations?
Sure. Yeah. So let me just to before I get into that research, to circle back to something that one of the things we learned in that paper that's very closely related to the work on
Yeah.
intangibles is the importance of these data assets.
Mm.
So we, for years, as consumers, have been benefiting from lower prices on everything from our groceries to our video games,
Yeah.
because we have sold the data, about our consumption patterns or gaming patterns or whatever it is. These data sets that firms have are so incredibly
Yeah.
valuable now that AI can be used to help understand what products are useful, what people like, how to price them, how to improve them, et cetera. So the work that I have on generative AI is very labor focused. So to give you a little flavor, the um, the U.S. economy has, according to the BLS, about 923 occupations. Those occupations, so you are a
Yeah.
finance,
Yeah.
you're an investment professional, you are also, some kind of educator and entertainment professional, and same with me.
Yeah.
And our occupations are made up of a collection of tasks. We do
Right.
different things throughout the day. Sometimes we're crunching numbers, sometimes we're having great conversations,
Yeah.
sometimes we're coming up with new research topics, things like that. And teaching. And so there are 19,000 tasks that make up those occupations. And this generative AI revolution has really greatly increased the number of tasks that machines and software can do
I do.
with the help of coding and data.
Yeah.
So that research specifically focused on the impact on firm values from this productivity improvement, from the fact that now we have software and code that can enable computers to help execute or to fully execute the tasks that we do in our occupations. And for firms that can take advantage of that, that's a huge productivity improvement. Either it's going to lower the cost because they can shift from labor to software, or it's going to just improve productivity and boost output from the fact that you and I have just got this great engine, and we
Yeah.
can just, accelerate that much faster to wherever we want to get. And I'm sure you are also using
Yeah.
this every day. In my leisure, I'm using it. I did a college tour with my family, and I used it to find the restaurants in all these towns. And I'm using it in my daily work to help with coding, to help make slides, to help summarize things for me. So it's just a really exciting time, and it's very exciting for firms
Yeah.
and firm values. And people are very focused on, we hear a lot about chip makers, and now we're hearing a lot about utilities and, kind of energy firms. But the impact of this general purpose technology is economy wide. It is going to change every
Everything.
industry, and it offers opportunities in every industry for firms that have the organization capital to take advantage of it and the data assets to really customize it and give them an edge over what the kind of generic version would be. So it is a really exciting time, I think, to be in finance and in economics, and just a part of this new technology and this next wave of information revolution that we're going through.
Yeah. And my question would be, because you are an educator working with students and helping them find their pathways, what are you seeing as far as how they're using AI in their coursework, and what are you advising them as far as where they want to go in their occupations and entering the workforce?
Yeah, so this year was completely different for me than any other year,
Yeah.
because it really was. So any assignment they had to do, any exam they had to take, a presentation they were going to make, I wanted them to use generative AI because that's the way they're going
Right.
to work, right? You can't handicap and keep people off the frontier. So they did, and what they came up with in terms of, they do some business proposals, they do industry analyses, they create pro forma accounting statements, they
Yeah.
take exams, they do
Yeah.
payoff diagrams, and
Yeah.
um, whatever AI they're using is coding up those payoff diagrams for options in Python for
Yeah.
them.
Yeah. Yeah.
So what that means is, you can't be, none of us can be, we're so far from being human calculators now. We get to unleash
Yeah.
our creativity.
Yeah.
We get to unleash our communication skills. I think, kind of every person who drives this engine just increases the breadth and depth of what they can do with their talent. So
Yeah.
I don't know if it changes, your occupation should also, to the extent that you can, make it that thing that just you're excited to do
Yeah.
every day. If it gets you out of bed, you're, for better or worse, you're thinking about it on the weekends. So I don't know if you should change your occupation based on, technological changes, but at the margin, you adopt those technologies and it opens up new directions. You always pick the one that's the most fun for you. And, I'm an economist, no such thing as a
Yeah.
free lunch. It's got to be fun and it's got to pay the bills.
Right.
So you use that generative AI to make sure that you get that kind of the frontier, the optimal portfolio of those things for you.
Yes, I love it. I love it. All right, Andrea, I appreciate you coming on the show today. Is there anything that we didn't cover that you want to share with our audience?
I don't think so. This was such a great conversation, and you're so kind to have done all the research and get on board with the intangible asset revolution. So I think we
I
covered
am
it.
on board with the Intangible Asset Revolution. I absolutely love the work you're doing. I can't wait to see what else comes out here, Andrea. And moving forward, you have an open invite to come back on the show and discuss any of these topics: intangible assets, AI, the work you're doing at UCLA. Thank you so much for coming on the show.
It was such a good time, Rory. Thanks so much.
Thank you so much. All right.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.